Were you aware that there are investments where the IRS will actively help you generate wealth? And the vast majority of Americans have absolutely no idea these opportunities exist. Not in a roundabout way, not through some indirect mechanism. I mean, the government will literally subsidize what you put your money into if you understand where to look. So why would they do something like that? The answer is straightforward. The government needs to motivate Americans to do things that the private sector does better than any federal agency ever could. Learning to read the tax code the way you would read an instruction manual is arguably the single most powerful step you can take on your personal wealth-building journey. But most people have zero interest in wading through tax legislation on their own. That is exactly why I am here. To break it down, make it digestible, and show you precisely where to put your money so that the tax system is actively working in your favor, rather than quietly working against you. Here at Social Security Decoded, we believe financial clarity is something every American deserves. So today, I am going to show you exactly how this works and explain why the very same tax code that drains money from most people is simultaneously and quietly helping others accumulate serious wealth. And I want to be clear, there is nothing sinister or underhanded about any of this. The system genuinely exists to make America stronger and to help more Americans build lasting financial security. You simply need to know where to direct your attention. After 25 years of practice as both a CPA and a tax attorney, I can tell you with complete confidence that wealthy people understand something the average person does not. The tax code is not fundamentally about taxes. It is fundamentally about incentives. My name is Arthur, and what I want to do today is help you begin thinking the way people think when they use the system intelligently, rather than spending their energy fighting against it. Stay with me all the way through because at the end, I am going to show you how every one of these investment categories can be woven together into a real, actionable, integrated financial strategy. Before we get into the first investment category, however, there is a foundational concept that most people completely overlook. And this is the mindset shift that changes absolutely everything once it clicks. The tax code was never designed to be fair. It was designed to shape behavior. Congress has an agenda. Build more housing, create employment opportunities, produce domestic energy, grow the overall economy. When we elect our senators and representatives at both the state and federal levels, their job is to translate policy goals into law, and tax incentives are one of the most effective tools available for achieving those goals. The underlying idea is this: how can elected officials help the people in their communities and across the country build more wealth and financial stability? And here's the part that I think most people actually do understand on some level. The government is genuinely not equipped to execute all of these economic goals on its own. So instead, it turns to ordinary Americans and essentially says, if you are willing to go do this, we will reward you with a meaningful tax reduction. And when you take that deal, you can actually come out significantly ahead financially because you are putting your capital into exactly what society has collectively agreed to reward. So let us begin with number one, which probably will not come as a great shock, and that is real estate. This is the arena where wealthy individuals have quietly accumulated generational wealth for decades. Let me walk you through an example that makes the entire concept crystal clear. Some of you will remember Hurricane Katrina, one of the most devastating natural disasters in modern American history. Nearly 20 years ago, that storm carved a path of destruction through Louisiana, Texas, and several surrounding states. The federal government, as you may recall, struggled so severely in the immediate response that it could not even get water to the Astrodome for an entire week. It was a catastrophic failure of government logistics. In the weeks and months that followed, lawmakers asked a fundamental question: how do we accelerate the rebuilding of these communities? Entire neighborhoods had been wiped out. Infrastructure had to be rebuilt from zero. So the government made a decision. They created a depreciation incentive and named it the Go Zone. That is literally what the legislation was called. The message sent to investors across the country was direct and compelling. Come to any area damaged by Katrina, build homes, and invest in real estate there. And we will give you a 100% deduction on the cost of the structures in the very year you complete construction. That represented an enormous tax benefit. Consider the math. You might put $100,000 down and secure a $300,000 mortgage to construct a new home for a family. After subtracting the value of the land, you might walk away with a $300,000 to $400,000 tax write-off, even though your actual out-of-pocket investment was only $100,000. On top of that write-off, you collect rental income, build equity, and eventually sell into an appreciating market. Investors from across the country moved quickly. They flooded into the affected areas and began rebuilding communities at a pace that no government program could have matched. Investors won financially. Families got housing far faster than any federal initiative could have provided. The government accomplished a massive reconstruction goal by channeling private capital rather than bureaucratic effort. All of it was made possible through a carefully crafted piece of tax legislation. I was working as a tax attorney during that period, helping hundreds of investors navigate the go zone opportunity, and I watched a significant number of people create substantial wealth in a remarkably short window of time. Some of you might wonder whether that kind of arrangement is truly legitimate. The answer is that it was not just permitted, it was intentional. The government engineered that outcome through the strategic use of depreciation. Investors were able to write off the value of the structures, not the land. And as those properties increased in value, capital gains incentives sweetened the deal further. You were simultaneously collecting rental income, building equity through appreciation, and recording a paper loss on your tax return that exceeded your actual cash investment because leverage amplified everything. That is a genuinely powerful combination. And the good news is that similarly powerful strategies remain fully available in today's market. Cost segregation studies and bonus depreciation provisions allow investors to front-load massive tax deductions, often concentrated entirely within the first year of ownership, when they acquire rental or investment property. I regularly see investors purchase a single property and generate six-figure deductions within 12 months. And this does not apply exclusively to disaster recovery zones. It applies to short-term rentals such as Airbnb and vacation properties, traditional long-term rentals, student housing near college campuses, multi-unit residential buildings, commercial properties, and virtually any other category of depreciable real estate you can name. Beyond that, new Opportunity Zone tax incentives are scheduled to take effect beginning January 1st of 2027. Keep those on your radar. Low-income housing carries its own extraordinary incentive structure. I am personally involved in a project right now that uses Section 8 federally guaranteed rental income to support investors building in low-income housing areas. The list genuinely continues. Strategy number 1 is real estate investing across its many forms, combined with the tax strategies that allow your wealth to compound at an exponentially faster rate. Number 2 is oil and gas. As you have followed in the news, domestic energy production, fuel costs, and drilling activity inside the United States are major topics of national conversation and policy priority. It matters significantly to this country that we maximize our extraction of domestic natural resources before we find ourselves dependent on foreign suppliers, including obviously the nations of the Middle East. As a result, the government has created meaningful financial incentives for Americans willing to invest in domestic drilling projects. These can become fairly technical, so I will focus on the highlights that matter most. The first opportunity involves direct investment in a drilling project through what is called the Intangible Drilling Cost Strategy, commonly referred to as an IDC. Under an IDC arrangement, investors can sometimes deduct as much as 80% of their first-year investment as a tax write-off related to the depreciation of equipment used in the oil and gas project. Additionally, once production begins generating royalty income, whether you participated in the initial drilling or acquired a royalty interest afterward, you can shield the first 15% of that income from taxation entirely through what is called the depletion allowance. The practical result is that investing in oil and gas can deliver substantial upfront write-offs that reduce your current year tax burden significantly, tax-advantaged cash flow on 85% rather than 100% of your royalty income, and the long-term value appreciation of a productive drilling operation. These investments carry real complexity and demand careful personal research, but for the right investor working with the right team, the combination of tax efficiency and income potential is genuinely compelling. I have hundreds of clients who pursue oil and gas investments specifically because of their exceptional tax treatment. Number 3 is retirement accounts. At this point, some of you might be thinking, Mark, what exactly should I be investing in inside a retirement account? I want to pause and clarify something important. What I am describing here is not about the specific assets you hold within a retirement account. And for those of you familiar with my other content, you know I am deeply passionate about self-directing retirement accounts into alternative assets. Please explore my other videos on that topic. What I am addressing here is the retirement account itself as a government-subsidized wealth-building vehicle. The reasoning behind the government's generosity with these accounts is fairly straightforward. Social Security alone is simply not sufficient to support a dignified retirement for most Americans. Millions of people are reaching retirement age without adequate savings. The government's response has been to create powerful financial incentives designed to encourage Americans to save more consistently throughout their working lives. When more Americans accumulate meaningful retirement savings, it reduces financial stress across the broader population and takes pressure off the Social Security system as a whole. When these accounts are structured thoughtfully, the opportunities are far broader than most people realize. Many people do not know they can maintain multiple 401k accounts simultaneously, including a solo 401k for a side business. Access Roth accounts regardless of their income level through legal backdoor strategies, and receive actual tax credits simply for establishing these accounts in the first place. Let me run through a few highlights to get your thinking moving in the right direction. First, you can receive a tax credit of $500 per year for up to 3 years, totaling $500, simply for opening a 401k, whether for yourself, your business, or your employees. The government is literally paying you just to establish the account before a single dollar of contributions has been made. Second, the new Trump accounts allow parents or grandparents to deposit up to $5,000 into an account on behalf of a child or grandchild before they turn 18. Children born within a specific 3-year window even receive an additional $1,000 contribution from the government as a head start. Third, traditional IRA contributions, up to $7,500 or $8,600 depending on your age this year, can be deducted directly on the front page of your tax return. And then there is the Roth IRA, which I genuinely love. You contribute after-tax dollars, the account grows completely tax-free, and every qualified withdrawal comes out tax-free as well. If you have been told your income is too high to contribute to a Roth, I encourage you to search for Backdoor Roth IRA Mark Kohler after this video and explore how to make Roth contributions regardless of your income level. Finally, 401k contribution limits this year reach $2,400, with an additional $8,000 available depending on your age. You can participate in a workplace 401k and capture employer matching contributions while simultaneously operating a solo 401k through your own business. If you have employees, a safe harbor 401k structure allows you to earn tax credits for establishing it, take a full deduction when you fund it, support your team's financial security, and benefit directly yourself in the process. Structured strategically, these accounts allow you to reduce your current tax burden, grow wealth in a completely tax-advantaged environment, and withdraw funds in a deliberate and tax-efficient sequence later in life. Number 4 is healthcare. Let me start with the Health Savings Account, which is genuinely one of my absolute favorite financial tools in the entire tax code. If you have followed my work for any length of time, you already know how enthusiastically I advocate for the HSA. Here is why. Contributions go in as a tax deduction. The money grows completely tax-free inside the account. Withdrawals come out entirely tax-free when used for qualifying medical expenses, and that list of qualifying expenses is extensive. Unlike a retirement account, you do not have to wait until age 59 and a half to access the funds. You can self-direct the HSA into virtually any investment you choose. And this year, depending on whether you are single, head of household, or married, and factoring in your age, you can contribute anywhere from $4,400 to $10,750 annually. The reason the government created this incentive is rooted in a sobering reality. Medical expenses are the leading cause of personal bankruptcy in this country. The financial exposure is significant, and the HSA is one of the most powerful tools available for building a dedicated healthcare reserve. For small business owners, there is an additional healthcare incentive worth knowing. If you are covering at least 50% of your employees' health insurance premiums, you can claim a dollar-for-dollar tax credit of up to 35% of what you are paying. That is a direct reduction in your actual tax liability, not merely a deduction, a credit. Whether you are an individual building an HSA or a business owner covering your team's healthcare costs, there is real money available to be saved and built through strategic healthcare planning. Number 5 is education expenses. For those currently enrolled in school, provisions like the American Opportunity Credit and the Lifetime Learning Credit provide direct tax incentives for tuition and related costs. But for parents, the planning opportunities available when you think ahead are even more significant. And the government is highly motivated to incentivize this kind of forward thinking given the trajectory of college costs. The Coverdell Education Savings Account allows you to deposit $2,000 annually, invested in essentially anything, and have the entire amount grow tax-free and come out tax-free when used for qualifying educational expenses. The 5 and 29 plan goes further, allowing contributions of up to $19,000 per beneficiary this year, with the same tax-free growth and tax-free distribution benefits for qualified education costs. If your financial plan includes education expenses either now or on the horizon, there are concrete strategies available that reduce your tax burden while allowing the government to effectively subsidize a meaningful portion of that college education. Number 6 is charitable giving, which I genuinely consider a form of investment. You are investing in people, in communities, and in the fabric of this country. When you give to causes you believe in, the tax code extends remarkable generosity in return. There are numerous pathways to a tax benefit, and the options extend well beyond simply writing a check to an established nonprofit. You can actually establish your own charitable organization. At our law firm, we help clients set up charitable structures every single month: foundations, public charities, private charities, and various combinations depending on each client's goals. Why do people pursue this? Hopefully, and I genuinely believe primarily, because they want to make a meaningful difference in the world. But the tax incentive structure is extraordinary as well. Charitable remainder. Trusts, which we discuss regularly, enable people facing large capital gains events to structure a plan that dramatically reduces, or in some cases completely eliminates, their tax exposure, while simultaneously directing significant resources to causes they care about now or through their estate. If any of this resonates with your situation, I encourage you to schedule a consultation with our team through the link below. You will very likely be surprised by the range of options available to you. And now number 7, which I saved for last because it is perhaps my personal favorite and the category I consider the most powerful catch-all on this entire list: starting a small business. Some of you might push back and say that starting a business is not really an investment. It is an income-generating activity. I would respectfully argue the opposite. When you start a small business, you are investing in yourself. You are investing in the American dream. And you are investing in this country in a way that carries a genuine ripple effect through the broader economy. Every dollar you spend with vendors and suppliers generates income for other families. The product or service you bring to market creates value for the people you serve. And the profit you generate, where you choose to deploy that capital, has the power to change lives, including your own and your family's. When you invest in yourself through business ownership, the list of available tax benefits and strategies is so extensive that I genuinely do not think you can count them all. There are business tax credits for hiring and training certain employees. The government will essentially pay you to bring specific individuals into your workforce. There is the research and development tax credit for businesses developing new ideas, products, or processes. There are incentives for adopting energy-efficient equipment and vehicles, fuel cost credits, and tax benefits for making your business premises accessible to individuals with disabilities. And then there is the extraordinary universe of legitimate business deductions available to anyone working to generate business income. Your effective tax rate on money earned through a properly structured small business is substantially lower than the rate you pay on W-2 wages from an employer. That does not mean you abandon your day job. It does not mean you walk away from employment income. The most financially successful clients I work with almost universally maintain both a stable employment income and an actively growing business. The combination of security and entrepreneurial upside, paired with the tax advantages that come with each, creates an exceptionally powerful financial foundation. Here is what I want you to walk away with from this entire conversation. The IRS is not distributing tax breaks randomly or arbitrarily. They are rewarding specific behaviors. So the real question you need to sit with is this: are you engaged in the behaviors the tax code is designed to reward? Or are you trapped in a cycle of earning income, paying tax, and repeating the same pattern indefinitely? Because those are two fundamentally different financial trajectories. The most common mistake people make when they face a large tax bill is believing they simply need a more skilled accountant. That belief is incorrect. What they actually need is a better strategy. Tax savings does not begin with your CPA. It begins with your decisions, your knowledge, and your understanding of how the system works. What you invest in, what you educate yourself about, how you structure your affairs, and how you execute on that structure. That is where the real leverage lives. If you feel like you are working hard, generating solid income, but consistently watching a significant portion of it disappear to taxes, it is most likely not because you are doing anything wrong. It is because nobody has ever walked you through how the system is actually designed to work. Once you genuinely understand that the tax code is a structured set of incentives rather than an arbitrary collection of rules, your entire financial perspective shifts. That shift is probably a significant part of why you are here watching this video today. My goal is to give you as many strategies, ideas, and potential course corrections as possible that will make your path to financial independence more achievable and keep more of what you earn working for you, rather than flowing to the government unnecessarily. If you are ready to build a tax strategy that genuinely aligns with what the IRS is incentivizing, whether that means structuring a business, investing in real estate, exploring oil and gas opportunities, or designing a charitable giving plan, our team at KKS Lawyers is ready to help you do exactly that. We work alongside business owners and investors every single day to design proactive, legally sound tax strategies that keep more money where it belongs, in your pocket, so you can live the American dream more fully and on your own terms. Check out the link in the description below to learn more and take the first step. And if this video delivered value for you today, please hit the like button, subscribe to Social Security Decoded, and turn on notifications so you never miss content that could meaningfully change your financial future. I am Arthur. Thank you genuinely for watching, and I will see you in the next video.